Losing a spouse can be one of the most difficult things a person can go through. In a moment, your world and future plans are turned completely upside down. Now, many of us readily think about the emotional pain this will cause us, but from a retirement planning perspective, there's also a lot of financial pain here created as well. This is due to something called the widow trap. Now, let's say we have a married couple, ages 78 and 80, and they have a reasonable Social Security benefit and a little bit more than $1 million in tax-deferred accounts, which at this point are causing them to take out an almost $65,000 RMD. In addition, they have a pension and some small taxable interest. In total, their gross income is just shy of $150,000. Well, when one spouse passes away, quite a few things change in their retirement plan. From a Social Security standpoint, they will lose the lower of the two benefits. Now, they're able to keep the higher of the two Social Security benefits, but they will lose one of those benefits. How the RMD situation adjusts will be dependent on the ages of the couple. Typically, a spouse has a few different options when they inherit the deceased spouse's accounts. In this situation, the husband was older, so the best path for the wife, in order to minimize future RMDs, will be to inherit and retitle his accounts in her name. This means that all future RMDs will be based solely on her age, which will be a reduced RMD rate. In this case, the adjustment will mean the RMD drops about $5,000. In this specific case, the couple had a 75% survivorship option on the pension. So that's going to drop from $14,000 down to $10,500. Now, this adjustment is completely dependent, however, on that survivorship option. Then finally, taxable interest remains unchanged. Now, as we dig to the overall gross income numbers, we see the new gross income number for the widow is just under $110,000, a 26% reduction in income. Now, luckily, when this couple was married, they had excess income. They weren't spending that full $150,000. Now, as a widow, nearly $110,000 is probably still enough for most single retirees. But adjust the situation slightly differently, and we can see how impactful a reduction of income may be for some families. With no pension, smaller IRAs, and a smaller Social Security benefit, this income reduction may put undue stress on the retirement's income plan. But there's more to this situation than what it first appears. Not only does gross income drop, but more importantly, after-tax income drops at a greater rate. This is because when one spouse dies, you go from the married filing jointly brackets, and you revert back to the single filers bracket. Every bracket cuts in half. The standard deduction cuts in half. Single filer brackets aren't exactly forgiving to single retirees. If you're a retiree that's not married, you're very aware of this dynamic already. As a married person, you rarely need double the income of a single retiree in order to live. Certain expenses, like housing, are a shared expense. Typically, a married couple might need 30% more income, but they get twice the room in each tax bracket. Now, when you or your spouse passes away, your bracket's cut in half, and typically we see that tax bill rise substantially. This isn't the only change creating the widow trap, however. Medicare penalty zones also cut in half, or the room that you have in each Medicare penalty zone rather cuts in half. In the example we shared earlier, the married couple wouldn't have to worry about IRMA. The widower, however, immediately finds herself owing an extra $1,000 for Medicare due to these IRMA zones. In fact, she's only a little bit away from seeing the next IRMA zone, which will likely happen in the next few years with increasing RMDs. Big picture, however, here's what happens. The married couple's tax liability is just over $13,000. In this specific situation, they live in South Carolina, so there are some small state taxes owed here. With no IRMA, this comes to an effective tax rate of just over $8,000, with showing nearly $150,000 worth of gross income. When the husband dies, however, the overall tax bill we see rises 35%. $2,500 more for Fed taxes, $1,500 more for state taxes, and then the cherry on top of all of this is a Medicare penalty near $1,000. The tax bill rises to over $17,500, which comes to a nearly 16% effective tax rate, nearly double what they were paying as a married couple. Now, remember that this widow's gross income was about $110,000, but she's really only keeping about $92,000 of that after taxes. Now, putting this in perspective, she saw a 26% reduction in gross income and a 35% increase in taxes. Now, together, this lowered her after-tax income by a whopping 32%. This is exactly what we mean when we say the loss of a spouse can completely transform a retirement plan. Now, some couples will see bigger after-tax income reductions. Some may see slightly smaller ones. It's really dependent on your situation. The average reduction on a gross income basis is 35% according to the Social Security Administration's data. Every widow will see additional stress in their plan any way you slice it, however. Now, as a quick aside, know that these numbers get worse in 3 years. This is due to the expiring of an important tax window that we just recently recorded a video on. You should be able to view that in the upper right-hand corner by clicking that link. Know that we'll link to this video at the end of this video here as well. Said another way, any way you slice it, taxes are rising in 2026. But back to the widow trap. Here's the tough thing about planning for the widow trap. We know this is a trap every married couple will face, but we really don't know for how long. When we build a retirement plan, we try to set an expectation based on that specific person. So we might set a male to live to 89 and the female to live to 91. In the example on the screen, this happens to create a 4-year widow trap based on their current ages. Now, a 4-year widow trap is important to plan for, but is a smaller window, all things considered. The problem is life doesn't play out as cleanly as it might first look inside of a retirement plan. It might surprise you to know that the average age of a widower is just 59 years old. And looking at this data, we tend to see women hold a significant share of the widower group. So if you're a 59-year-old woman, and your life expectancy is at 84 years, which would be in the normal life expectancy tables, you'd see a 25-year widow trap. The point I'm trying to illustrate here is this can be a really difficult variable to plan for, but can be a real catalyst for some tax pain in most retirement plans. Because of this, it ends up being one of your most important tax planning hurdles. Now, let me illustrate why this is the case with a, quick case study. Here I have a couple in their mid-60s. They have a decent portion of their assets in tax-deferred accounts and are spending about $100,000 per year. Now here's a look at their forward-looking tax plan. Now when we're planning just inside of the normal expectations, we see that the widow trap is a 3-year trap here. Now prior to this trap, they found themselves taxed in the 22% bracket, what will be the 25% bracket come 2026. And as a married couple, they really only would ever see 1 or 2 Medicare penalty zones. But once the husband passes away, however, you can see this wife is thrust into 4 different penalty zones in terms of Medicare, in addition to being pushed into the 28% federal tax bracket. That's a lot of tax pain that this couple would end up seeing. There may be additional tax pain depending on what state they live in. Well, to alleviate this tax pain or even moving in the 22% bracket and the various hurdles they would see while they were both married, we'd want to implement strategic Roth conversions immediately. After running their plan through our tax software, we would find that the top 2 strategies are actually pretty close. Maxing out the 22% bracket, and then what we'll refer to as a Tax Cuts and Jobs Act optimized strategy. And as you can see, there's not a clear distinction between which is best from those 2. They're pretty close. After-tax benefits rise well over north of $500,000. The dotted line on the screen is just as an anchor point as we walk through the next scenario that we're going to show. Now, because these strategies both come close, I would personally recommend we go a little bit more conservative and only max out the 22% bracket. The reason for this is simply risk mitigation and making sure those Roth conversions don't actually hurt our plan. But what if we adjust the expectations and we look at the possibility of that husband dying 10 years earlier? We see now this widow hit nearly every IRMA penalty on their way up into the 32% bracket later in retirement. This is a wildly different forward-looking tax plan. Said another way, if not planned for carefully, this widow will see her tax bill rise, the amount that she's able to keep and enjoy will drop precipitously. Now, because of this longer widow trap, we'll see some pretty substantial changes when it comes to those optimal Roth conversion targets. Now, the most aggressive strategy that involves maxing out the 24% bracket now inside of that Tax Cuts and Jobs Act window, and then max out the 25% after 2025, now wins handily. They're not as close. It's very common in our research that the widow trap can shift that optimal strategy up 1 zone to the next more aggressive strategy. For instance, if your best path forward from a tax planning perspective right now is maxing out that 12% bracket, a long widow trap is likely to shift the best strategy to being maxing out the 22% bracket, moving up a zone. And that's exactly what we see here. Before, both strategies were right in line, almost indistinguishable. And the tax savings rose slightly above $600,000 towards the end of their plan. Now we see the tax savings rise to $1 million at the end of the plan, and we see a big gap between the best strategy and then the previous strategy we were looking at. This just goes to show how detrimental that widow trap can actually be in retirement, and thus how important tax planning can be as well. Now, keep in mind the timing of this trap, again, is unknown for most couples. I'm not saying that you should adjust your entire tax plan based on the possibility of seeing this tax trap for a good portion of your retirement. But you should know how your plan changes if it happens. This means stress testing your plan, both from a tax standpoint, as we just walked through with that given case study, but then also from a probability of success standpoint. We want to make sure that your probability of success isn't affected by losing out on some income or seeing a reduction in income. The point here being is you have to be building a proactive plan in order to avoid this trap. We cannot act reactively once we're already inside of that widow trap. It's too late at that point. Now, the biggest financial risk for the widow trap will come for those retirees with a wide age gap between spouses. You'll also see pensioners who don't choose the right survivorship option see a reduction in income exactly for that reason, and thus see financial risk for that reason. In addition, know that there are other strategies you can use to lessen the impact. One of those would be disinheritance. Say your spouse passes and there's little probability of success risk to your plan, maybe because of guaranteed income, or maybe you just have some really sizable assets in your name. If your spouse also has sizable assets and therefore that represents a large RMD that's going to be passed to you that you're going to be forced to take in that widow trap, know that you can choose to disinherit their accounts or even certain accounts. The money would then pass to contingent beneficiaries. With multiple beneficiaries, you might find that they can withdraw from those accounts at a lower tax bill than you can withdraw. And if they're going to end up with that money anyway, it might be better to pass it on sooner rather than later. Furthermore, keep in mind the other tax planning hurdles that we often talk about on this channel, like the tax hikes that we're expecting coming in 2026. I show right here in this video why many retirement tax bills will rise 20 to 25% just from the sunsetting of the current laws that we're using today. Click on this video to learn more, and always remember, you don't need more money, you need a better plan. Thanks for watching.